Good evening, everyone. Today we're looking at FR, financial reporting, and our topic will be IAS37, provisions, contingent liabilities, and contingent assets. This is a standard that we need to understand very well, because so many people don't understand the meaning of contingent liability and provisions and contingent asset. So let's look at the objective of this standard. So the objective of the standard is to ensure that appropriate recognition criteria and measurement basis are applied to provisions. So before you can say, okay, this is a provision, you don't just provide for an expenses. There must be a recognition criteria before an item will be classified as provisions. That's the reason why in taxation, when they see the word provision, they had it back. It's disallowable expenses, because they find out that most companies use provisions to reduce their tax liability and which is to reduce their profit. So many companies you can use this to achieve different aims. So that is why we should understand the meaning of provisions very well, and what is the difference between a provision and a contingent liability and contingent asset. And that sufficient information is disclosed in the notes to enable users to understand their nature, timing, and amounts. So when it comes to disclosure, we're talking about a contingent. It can be liability, it can be asset. Now, I would say this standard does not. Other standards talk about provisions. So this standard does not apply for provisions under the following standards. So the standard shall be applied to all entities in accounting for provisions, contingent liabilities, and contingent assets, except so this standard or these transactions, this standard does not cover these transactions. So you use the respective standard that are listed here to treat the provisions. For one, financial instrument. What's a financial instrument? The way we provide for any provisions under financial instruments. What is a provision that relates to financial instruments, be it shares and the rest. So you use IFRS 9. So IFRS 9 talks about how you can recognize any provisions for any instrument. This standard does not apply to executory contracts unless they are onerous. Unless they are onerous, so they apply to executory contract. Not contracts that will be executed. So that contract is bad, it will give you loss at the beginning. You foresee that this contract, if I call this contract, is loss that the company will make. So that's only when you can recognize provision. IAS12, income tax. If you find that income tax, that deferred liability, deferred asset is a provision. So you have to follow that the standard to recognize income tax provisions. So don't use the standard. Lease, which is IFRS 16 lease. So you use IFRS 16 lease to treat other provisions, like provisions for liabilities. There's the present value of liability. Those provisions you use the standard IFRS 16. So all these standards talk about their provision in specific. So you use their standard. Like for example, IAS19, employee benefit. Employee benefit also talk about provisions, but we provide for employee benefits. So the measurement. So we use IAS19. And we have insurance contract. Insurance contract also provide for some provisions under that standard insurance contract. So we also use that standard to apply for that. Now, continuous consideration of an acquired in a business. So if you acquired a business, I purchase a business. Now, you pay a contingent value. So that value should be applied in accordance with what IFRS 3 business combination. We have revenue. So any revenue that you incur from customers, that you have a provision for, let me say like a warrant, because when you some business or some entity, when they sell their product, they sell with warrant, with a guarantee, with a warrant. That means if you return the product within so period, so they'll give you money back. So that provision, as long as is related to revenue, you should use IFRS 15 for that. Then when a restructuring meets the definition of a discontinued operation, additional disclosures may be required by IFRS 5. So when you want to restructure, though restructuring is under IAS37. When a restructuring meets the criteria for discontinued operation, maybe you want to discontinue a particular operation, line of business, so you must use the provision of what? IFRS 5. Now let's define what is provisions. So a provision is a liability of uncertain timing or amount. That's a provision. Provision is a liability. Thank God you know the meaning of a liability. So provision is a liability. Though provision, the amount and the time which we will pay and amount we will pay is not known. That is why they call it a provision, because the amount is not known. That's why it's called a provision. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embezzling economic benefit. So we're saying a liability should be a past event. I mean, you incur a liability for a previous transaction or for a previous agreement. So it's not a present something. So it's a past event, and the settlement of that liability must comes out from the inflow of the entity. That means it must be an outflow from the resources of that entity. Be it they can pay in terms of asset, they can pay in terms of equity. So it depends on how they want to pay their liability. An obligating event. What is an obligating event? You must understand it. An obligating event. They may ask us in the exam. You should define the difference between an obligating event and a legal obligation. An obligating event is an event that creates a legal or constructed obligation that results in an entity having no realistic alternative to settling that obligation. A legal obligation is an obligation that derives from. So before you can say an obligation is legal, when you can be sued in court for any obligation that you must fulfill, it must derive from one, a contract. Remember that in a contract, there is in business law or contract law, one party must not breach the contract, the agreement. So as long as you are in a contract, you must fulfill your obligation. So with that, you have entered what? A legal obligation. By legislation, some like laws of the country. As a company in a particular country, you are obliged to do the rules and regulations of that company. So if not, you pay fines. That's why there'll be penalty for that. Other operation of law. So there's other laws. For example, the NAFDAC. If you're into food and other and eatable items, NAFDAC, they have laws. So your product must be registered. So all those things, they are other laws. A constructive obligation. What is a constructive obligation? It's an obligation that derives from an entity's action. When you say it's a constructive obligation, where by an established pattern of past practice published policies or a sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. So when say is a constitutive obligation, whereby you've already given information to the public that you will pay a particular amount as dividend, that is an obligation, it's a constitutive obligation, or you will pay something, or you will fulfill something. So it's an obligation to that company. Another way you can have a constructive obligation is as a result, the entity has created a valid expectation on the part of those other parties that will discharge those responsibility. So you've already created an impression to the other party that yes, this and this, you're going to do it. So that is a constructive obligation. For example, you want to be listed in the stock exchange. You have already entered a constructive obligation with the stock exchange, so you have to fulfill those requirements of the exchange. Yes. So a contingent liability. So what is a contingent liability? We said it's a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not only within the control of the entities. So that when we say it's a contingent liability, is when it must be a possible obligation. That means it might occur, it might not occur. That's why we say it's a possible obligation. And the occurrence depend on a certain the existence of that liability depend on a certain occurrence. So something might happen before you can pay that amount, and that amount you want to pay in the future is not known and is not in the control of the entity. For example, a court case. When the company is sued in a court case, the company might not know the actual liability that it will pay, and it might not know if it will win the case or not. So that is what we call a contingent liability. Or is a present obligation that arises from past events but not recognized. Not recognized because it is not probable that an outflow of resources embodying economic benefit would be required to settle the obligation. Because it's not probable, it's not highly probable, it's not certain that you incur that liability. What if the court, the judge rule in favor of that entity? You're not paying liability. So it's not certain, it's not highly probable. The amount of the obligation cannot be measured with sufficient. Remember that before you can measure an items in a financial statement, the amount, the cost must be measured reliably. So when the cost is not measured reliably, so you don't recognize that provision. That's why it's called a contingent liability. Now, what's the contingent asset? A contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not only within the control of the entity. That's a contingent asset. And what is an onerous contract? What is an onerous contract? An onerous contract is a contract in which the unavoidable costs of meeting the obligation under the contract exceed the economic benefits expected to be received under it. Now, we say an onerous contract is bad from the beginning. That means all the costs that you must incur, the relevant costs you must incur to execute that contract is higher than the benefit, the income you will receive on that contract. That means the contract from the beginning, from the onset, will result in a loss. You may not make profit on that contract. Such contract is called an onerous contract. So such contracts, you can recognize the loss immediately. Now, what is restructuring? Restructuring is a program that is planned and controlled by management and materially changes either So it's a program that is planned by management and must actually change either the scope of the business undertaken by an entity or the manner in which that business is conducted. So what is executory contract? A contract under which neither party has performed any of its obligation, nor both parties have partially performed their obligations to an equal extent. Let me say an executory contract. Now that contract is either the contract both parties they not perform any obligation, so they don't owe each other. So it's as if it's done or not. There is no contract between both parties. So that is an executory contract, or a contract in which both parties they have contributed an equal obligation, so they perform equal obligation on their part. So that means that contract is an executory contract. So let's define what is provisions and other liability. So you can say a provisions can be distinguished from other liabilities such as trade payables and accruals because it is uncertainty about the timing or the amount of the future expenditure required in settlement. Because a provision is depends on other liability. When we say a liability like a trade payable, they are not provisions because the amount of trade payable is known and does not depend on on a certain or a certain circumstances. The relationship between provisions and contingent liability. Let's know the relationship. In general sense, all provisions are contingent because they are uncertain in timing or amount. IAS37 distinguishes between the two by using the term contingent for assets and liability that are not recognized because their existence will be confirmed only on the occurrence or non-occurrence of one or more uncertain future events, not only within the control of the entity. That is why they say provision is different from contingent liability. But a provisions, they are almost the same thing, provision and liability. But the way you say a provision is different from liability because a provisions is recognized in the financial statement, does not the occurrence or non occurrence of provision does not depend on a certain event. So, but a contingent is either an asset or liability. The occurrence or non-occurrence or the existence of that depend on an occurrence or non-occurrence of a particular event, future event. So, what is the? Let's go to recognition criteria for provisions. Now, provisions must be recognized when certain conditions have been met. Those conditions are met when normally a provision you will not recognize provision except these three criteria is met by the entity. So when the company meets these criteria, then they should recognize provisions. One, an entity has a present legal or constructive obligations to transfer economic benefit as a result of past events. So before you can recognize a provision, there must be a present or a legal obligations to transfer resources as a result of a past event. And it is probable that an outflow of resources economic benefit will be required to settle the obligation. And three, a reliable estimate of provisions can be made or obligations can be made. So if these conditions are not met, a provision should not be recognized. Then the liability is then disclosed as contingent liability. Now let's look at a present obligation. Before you can say, a present obligation exists when the entity has no realistic alternative but to make the transfer of economic benefit because of a past event. So let's look at the present obligations. Though I've explained this, a provision should be made only if the liability exists independent of the entity's future actions. For you can say it's a present obligation, then the liability must exist independently. If the entities remain discretion to avoid making any expenditure, a liability does not exist and no provision is recognized. Now, if the entities has the discretion, the right to control the payment or non-payment of a particular expenditure, the net expenditure should not be recognized as provisions. The mere existence of environmental contaminations does not in itself give rise to an obligation because the entity could choose not to clean it up. So, for example, that is why businesses or companies they find out that the environment is dirty, is contaminated, that is dirty the environment of the company is dirty. They might not recognize provision because the standard does not recognize that as a provision. So and the company has the right to clean it up or not. So that's why it must recognize a provision. A board decisions alone is not sufficient for the recognition of a provision because the board could reserve the action. So these are reasons why provisions should be recognized and why it should not be recognized. Past events. Let's talk about past events very well. A past event that lead to a present obligation is called an obligating event. Say, well, okay, this event, okay, what kind of past event lead to an obligating event? It will say any past event that will lead to a present obligation is called an obligating event. An obligating event exists when the entity has no realistic alternative but to make transfer of economic benefit. This could be legal or constructive obligations. So a reliable estimate of the obligations. So a reasonable estimate can also always be made where an entity can determine a reliable range of possible outcomes. B or 2. Only in the extremely rare case will it be genuine impossible to make any quantitative qualifications of the obligations and therefore impossible to provide for it. Contingent assets and liability. So let's talk more on contingent assets and contingent liability. Now, with our time, let's look at probable transfer of resources. We need to understand this when we recognize something as provision, because provision and contingent liability, they are always the same thing. So it will be difficult to distinguish between a provision and a contingent liability. So in our next class, we will look at questions under this topic. For the purpose of IAS, a transfer of resources embodying economic benefit is regarded as probable. If the event is more likely than not to occur. So before you can say there is a resource will be transferred from the entity, before you say is highly probable, then the event is more likely to occur than not to occur. This appears to indicate a probability of more than 50%. Before you can say yes, an item is a provision, the probability must be more than 50%. By the time, if it's an individual, they say, okay, a company has 22% or 20% probability that it will incur 50 million naira in the future. So that value, it means that is a contingent liability because it's less than 50%, but from 51 and above, then is a provision. There is a provision. So when is individual or when you accumulate them together, then you can recognize it as a provisions. So let's look at measurement of provisions. The measurement of provisions. the best estimate, because for you to measure provisions, you must have the best estimate. That is the most reliable estimate. The amount recognized as provision shall be the best estimate of the expenditure required to settle the provisions present obligation at the end of the reporting period. The best estimate of the expenditure required to settle the present obligation is the amount that an entity should actually pay to settle the obligations at the end of the reporting period, or transfer it to a third party at that time. So before you can measure a best estimate, the management will use their skills before they can say, okay, this is the best estimate. Before they can say this is the best estimate. Now let's look at uncertainties. Now, that is for you to measure provisions, you must consider uncertainties and you must consider the best estimate. Now, uncertainties surrounding the amounts to be recognized as a provisions are dealt with by various means. According to the circumstances where the provisions were measured involves a large population of items. The obligation is estimated by weighing all possible outcomes by their associated probabilities. So before you can say this is a provision, you must weigh all possible outcomes. Okay, you have 5%, you have 2%, that something will occur, something will not occur. You have to weigh everything, the weighted average. Then someday, that is when you now recognize them. So let's look at so when there is uncertainty in the future, that is called expected value. So you use expected value. So let's look at illustration just to explain better when it comes to uncertainty. Paco sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defect that becomes apparent within the first 6 months of purchase. The company's past experience and the future expectations indicate the following pattern of likely repairs. So before you can make a provision, the company's board of directors will use their judgment, their past experience, and their future expectations to recognize a provision. So from that, they said in percentage, they said 75% goods sold none will be defect. That means none of them, of 5% of the goods sold, we get spoiled or we need repairs. They said 20% of the goods sold, 20% of the goods sold, we need a minor repairs. We need a minor repairs. 5% of the goods sold, we need a major repairs. So what is the obligation? The obligation is very simple. For the solution, it's just for you to look for the expected value. That means the percentage times up the value of the repairs. So for unknown, we have 5% times nil plus minor, which is 20% times 1 million plus 5, which is the major times. So we have sorry, it's a mistake. We have 400,000 naira as the provisions that will be recognized, which is you will debit profit or loss account and then credit current liability as provisions. So depending on the time being of that provision, it may be current, can be non-current. Now let's look at present value. Present value. Now, when the effect of the time value of money is material, when it's material, for example, you said the provision will be paid in 5 years' time, and it's very material, so you have to look for the present value.
The amount of provision shall be the present value of the expenditure expected to be required to settle the obligation. So always remember this. Our next class I will solve a question under present value. So that you understand under present value. The discount rate shall be the pre-tax rate that reflects current market assessment of the time value of money and the risk specific to the liability. So you can use the present value. So you have to discount it like your PV, because here there is no present value, is just for the all outflow. Now the future event. So before we can also recognize the provision, we must talk about the future event. Now the future events that may affect the amount required to settle an obligation shall be reflected in the amount of a provision where there is sufficient obligative evidence that they will occur. So the future events should also be considered. So the expected future events may be particularly important in measuring provisions. So you have to look at the future events. Okay, what will happen in the future? So you must consider it in measuring provision. For example, an entity may believe that the cost of cleaning up a site at the end of its life will be reduced by future changes in technology. So you find that okay, the cost you foresee that you incur in the future events, they might decrease or increase due to any advent of technology or no technology. So such an future event you should inculcate that in your provisions. The amount recognized reflects a reasonable expectation of technical qualified objective observers, taking account of all available evidence as to the technology that will be available at the time of the cleanup. So the future events, you should also consider things in the future. For example, a future event, if there is any legislation, any government legislation or laws that will reduce your provisions, your liability in the future. So you should also consider that future event in recognizing the provision for that year. So that's why you see increase or decrease in provision in your ATS or in your undergraduate level. So you always find that. So that is where they derive it, because of in the future event maybe you provide for 50 million 10 years time, and you now foresee that the government laws will reduce that. So you pay 50 million, you will pay 40 million. So there is a decrease in provision, which is an income. So that is also should be considered. Now, expected disposal of assets. Gain from the expected disposal of assets shall not be taken into account in measuring provisions. So when you see there is a gain from disposal of assets, so that disposal of assets should not form a provisions. Gain or disposal or the expected disposal of assets are not taken into account in measuring a provisions, even if the expected disposal is closely linked to the event giving rise to the provisions. Instead, an entity recognized gain or expected disposal of assets as expected by the standard dealing with the assets. So which is IAS 16. So when it comes to disposal of assets, you don't follow IAS 37. Now reimbursement. Now you foresee that you incur some provisions, and there will be a reimbursement to the company for later. For example, car, maybe you insure it, but before the insurance company pay, you have to purchase. You have to incur some liability. Where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, the reimbursement shall be recognized when and only when it is virtually certain that the reimbursement will be received if the entities settle the obligation. Yes, before you can recognize that insurance compensation, you have to be certain, you have to be sure that they will pay. not just recognize it because you have a policy with them. The reimbursement shall be treated as a separate account. So you have to treat that one separately as an account. The amount recognized for the reimbursement shall not exceed the amount of the provision. So if you want to give you a reimbursement, that amount recognized for a reimbursement should not exceed the provisions you incur. So there is no profit or gain on reimbursement. In the statement of comprehensive income, the expense relating to a provisions may be presented net of the amount recognized for reimbursement. So you can say, okay, this is the provision and this is the reimbursement. So the net is what you recognize as net provision. Changes in provisions. Provisions shall be reviewed at the end of each reporting period and adjusted to reflect the current best estimate outflows of the resources in bundling economic benefits will be required to settle the obligations. The provision shall be reversed. So when there is change in provisions, so you have to reverse the provision. When the discounting is used, the carrying amount of the provision increase in each period to reflect the passage of time. This increase is recognized as borrowing cost. So when there is a change, increase or decrease in provision, that should also be recognized. So with this, we've come to the part 1 of IAS37. Our next class we will finalize it, we will conclude it, we will solve more questions on IAS37. Thank you for your time.